Hey, in this last video, I'm gonna share with you my reversal strategy. So you've probably already watched my first strategy video on the opening range break and retest. Well, this is the second strategy I play. I only play two strategy and I really feel like those two strategy match really good together. So one is more for the open, for the breakout, and the reversal usually come a little bit later in the day after 10 a.m. Eastern time. And that's why I feel like those two strategy match really good together because they each have a specific time frame. So I'm never looking for two strategies in the same time. It's always one dedicated time for the opening range break and retest and another dedicated time for the reversal strategy. So for those reasons, they match really good together. And I'm looking forward, I'm excited to share with you that specific strategy and the way I play the reversal. So let's jump into the introduction to the strategy. So what is the reversal strategy? The reversal strategy is a counter trend strategy that focuses on identifying when a stock is overextended in one direction and likely to reverse back in the middle point. So it's a strategy where we are trying to catch the inflection point, and that's what's great about the reversal strategy is that you're able to in a lot of time catch either the high of the day or the low of the day, so you're really comfortable with your entry price. This strategy provides big movement as we are trying to catch high of the day or low of the day. We're trying to catch the inflection point and the move all the way back down if we're going short, for example. Now, why I think this strategy works so well. I see three main edge with that specific strategy. The first one is that stocks rarely move in a straight line. Of course, this one you need to take it with a grain of salt. There's some specific days where you're gonna have some stocks that just go up in one direction or go down in one direction, but most often than not, at some point in the day, the price is gonna reverse back down. Because the psychology behind that is that let's say you have a stock that had some positive news and it start going up for the first 30 minutes, first hour of the day. Well, the people that jump at the open or that were long for some swing trade, some long-term position, at some point they're going to be happy with their profits and they're going to want to start selling their shares. So that's usually going to end up in some kind of reverse back down, let's say to the VWAP before continuing in the same direction. So we're trying to capitalize on that move, on that pull back down. The second edge I see with this one is that large players often takes profit after a strong move, causing reversals, like I just said. And the third edge is that market makers and algorithm trap late buyers and sellers and reverse the trend. And we're gonna capitalize on that with that strategy. And we're gonna see together how I'm able to see those signs before they actually happen. The market conditions where this strategy is the most effective. The first criteria that I really look for is stocks trading inside the candle pivot point range. So we already saw together how we can read that indicator. So what I mean by that, trading inside the range, it's basically when the price is trading in between R4 and S4. And hopefully the range of the camps is pretty wide. So when you have a wide range, that's where the strategy is going to be the most effective because we're trying to short at one of those camera pivot point lines. We're going to see it more in detail just in a bit. Then strong trending stocks. When you have a stock trending really strongly in one direction, that's really good for the strategy because that usually means that there's a lot of volatility, a lot of interest, and we're trying to capitalize on the reverse back down into the middle of the value area. Then high volume, of course, high liquidity. That's what we want in terms of day trading in general. Then stocks that are extended from key level. We're trying to catch those stocks because they're usually going to pull back into, like I say, in the middle of the value. And I put the time frame here where I think is better, pretty much in between 10 a.m. and 1 p.m. That's the best time frame. That doesn't mean you cannot trade the strategy outside of those hours. You can find some decent setup before 10 a.m. and after 1 p.m. But really, most of my trades are in between 10 a.m. and 1 p.m. I will even say between 10 a.m. and 12, because usually in between 12 and 1 p.m. the volume kind of die a little bit and there's less movements. The ideal assets and time frame is the same thing as all my strategies that I ever play. I always focus on large cap stocks, so I'm not trading any kind of penny stock. I really focus on those biggest company like NVDA, like Tesla, Apple, AMD, PLTR. Those company moves pretty nicely. But you can also apply this strategy on futures or indexes. So if you like to trade NQ, ES, if you like to trade the QQQ, the NASDAQ, or the SPY, this strategy will work really nicely as well. Then stocks with high liquidity, that's what we're aiming for. We're aiming for a lot of volume, a lot of movement, and that will come with high liquidity stocks. So anything with earnings is great for that strategy. Then the time frame you want to watch is the 1 minute chart. So you always want to focus on this time frame. That's where all your execution is going to be. That doesn't mean you cannot look at other time frames. You can keep an eye on the 30-minute chart, even the daily chart for have a bias. But in terms of the execution, and if you want to keep things really simple, all you need is a 1 minute chart here. Now let's jump into the fun part of the presentation, which are the criteria. So everything we're looking for before jumping in the trade. The first thing you want to pay attention to is your where. So identifying the overextended move. And for that, we're going to use this specific indicator that we already saw together, which is the Camera pivot points. So we want to be long in between S3 and S4 and short in between R3 and R4. That's how the cams work. Then you want to be long over R4 and short under S4. So if we do a little recap together, if you haven't watched the previous part of my presentation or the other strategy where I talk about this indicator, basically what it means is that in between R4 and R3, we are in a selling range. So we are in a spot where the probability of the price starting to reverse back down in the middle of the value is higher. And in between S3 and S4 is the opposite. We're in a buying range where there's a higher probability that if the price comes down here, it will bounce and move higher. Basically, if you have a wide range, and that's what we're looking for with this strategy, you want to see the price just fluctuate like that. And how can you capitalize on that move? By going short here, here, and here. And by going long right here and right here. That's how it works. And we're going to see that we use those lines as resistance and support. So we want to go short here. We want to go short here. We want to go long here, potentially long here, then short here or long right here. That's how it works. So pretty straightforward, 4 lines, and that's where we're going to take our trades. But there's more we need to see for more confidence. The second thing you want to see is VPA, and this part is super important. VPA stands for volume price analysis, and we want to see a specific kind of VPA here. We want to see an anomaly. So we already had a presentation on the volume, so hopefully by now VPA is clear to you, but just a little recap quickly. We have 2 kinds of candlestick patterns here. So either you see the price going down while the volume is decreasing, that's what we call a bullish reversal because we see an exhaustion here. So we see the sellers still in control, pushing the price lower, but they're slowly lacking of momentum, and that's what we're seeing with the volume here. So if you see, for example, we have S3 right here, which is a spot where we are interested in going long, because it's a buying range. And while the price moved towards that buying range, we're seeing the volume decreasing. Well, here we are interested definitely in going long for a reversal higher. Same thing, opposite direction here. So if the price is going up, the buyers are in control, but they're slowly starting to lack momentum with volume decreasing. This is a bearish reversal sign. It's a sign of exhaustion. So if we have, for example, R4 right here, we are interested in going short here with the VPA sign, the VPA anomaly we have here. This is 2 examples with a mix of candlesticks, so a match of 3 candlesticks. If we have only 1 candle, we want to see 2 kinds here of VPA. Either we can see a wide price movement and a lower than average volume. That's a sign that something is weird here. There's some manipulation, because with a big movement of price, so a big candle with a big body here, we should normally see a high volume mix with it to be a confirmation. But in that case, this is divergence. This is an anomaly. So again, if we have R4 right here and the price going up to R4 is showing us that kind of VPA, we're interested in going short. The one that I see most often is a small price movement and above average volume. That's telling you that there's a big fight in between the buyers and the sellers. No one is really winning because it's only a small price movement, but we're seeing that there's a lot of interest because there's a lot of volume. So if you see that as a specific level, definitely you can be interested in taking the reversal. If you already watched the previous video where I talked about the volume and price analysis, you already saw this example, we already watched it together, but I think for this strategy will be worth it to see it again, more with eyes of a reversal trader. So let's analyze it candle by candle together. So the first 3 candles here going up, we see the volume increasing. So let's say, for example, that right here, we were having R3, so resistance 3 from the candle pivot point. And then the next candle after that, we see a rejection. So instant rejection from R3. There could be really tempting for us to jump short, but the thing that is missing is our VPA sign. And that's a tough thing about this strategy, because often you see the price going to your level and you're really excited to jump into a trade, and you're going to jump anyway, and just don't look if you have any kind of VPA, and that's going to cause you to lose a lot of trade. So got to be careful here and wait for a VPA sign. So here from R3, let's mark it again and keep it on the chart. This is a no trade. So let's keep reading here. Then the next 3 candlestick in a row, we're having now a decrease in volume. There it gets interesting. Let's say we were having R4 right here. So we have a resistance 3, and here we have a resistance 4. So R3 was a no trade. Now at R4, it gets interesting because we have our first anomaly with the price going up and the volume decreasing. And remember, this is a divergence. If we will have a confirmation with those 3 candlesticks going up, we should have an increase in volume. There would have been no trade. But now we see some sign of exhaustion, that the buyers are still pushing, but they're getting tired. It's getting tough for them here. There's less and less buyer interested in buying. Let's go with the next candle here. So we have a reverse hammer candle with super high volume. Now it's really interesting. Now we have our second anomaly. So 2 anomalies in a row right at R4. So here could be a great opportunities to go short, but it's still missing one thing before going short, and we're going to see it in the next slide what I'm looking for to have a lot more conviction that the trade is going to work. And after that, the 3 more candlestick we see here, still volume is decreasing, so another sign of weakness. So that's basically how I will read it as a reversal trader. And let's jump to the next slide to see the last thing I'm looking for before taking a trade. And after that, let's come back to this example and see where we will have entered a trade potentially. That last thing you want to see when the price goes to your candle pivot point level is a fair value gap, or you can call it a FVG. So like we already saw together, this is a set of 3 candles with a gap in the middle like we see in the picture. So you can have it either a bullish fair value gap or a bearish fair value gap. Same concept, different direction. So it's created by aggressive buying in that case and aggressive selling in that case. And what is really interesting about fair value gap is that the price often returns to fill the gap and use it as support or resistance. So let's say the price keep moving higher a little bit here, go back inside the range, and here should find some resistance, some support, and bounce and move higher. Where it gets interesting is when the price actually go back to fill the gap and don't use it as support in that case. So when you see that, often that fair value gap is going to turn from support to resistance. So you can see the price moving lower, maybe retest it here before making another leg down. So this is a sign that the price is reversing. So when you mix that with the reversal strategy at a cam level with some VPA sign, it gets extremely powerful. Same thing on the other side here. So you see the price going down, the sellers are in control. Now they go back to retest that fair value gap. Are they going to use it before making another leg down or push higher and fill the gap? Well, if they fill the gap here, that means that the reversal is valid. They might retest it and start moving back in the same direction. So the way we want to use the fair value gap for a strategy, let's say we have S3 right here. So this is S3. We see the price going down to S3. Let's say right here, this candle have super high volume. So we see a candle with small movement and really high volume. This is our VPA. The last thing we want to see, before entering the trade, we want to see the price go back, fill that gap, and right here is the spot where we're going to enter to the long side with conviction. So that will be our entry, and we're going to target the move higher here. That's how I use fair value gaps for that reversal strategy. Pretty straightforward, and I hope that was easy to understand. Now let's jump to the trade execution. So how I execute the trade in terms of entry, exits, how I manage my position. So the entry signals I'm looking for. Step number one, the price moves towards a selling range, R4 and R3 for a short, or a buying range, S4, S3 for a long, and then form a fair value gap at that specific level. Number two, I need to see some kind of VPA signal that the price is getting ready to reverse. So like we saw, an anomaly towards the range where I'm interested in going short or long. And then the last step I will enter when the fair value gap gets filled. If you're confused so far by what I mean with the fair value gap, how I enter a trade, just stick to the presentation. I'm getting there in a bit with some examples of how it actually looks like on a real chart and where I took some real trades. Then where I will place my stop loss. So like we already saw together in the risk management part of this course, there's a difference in between hard stop and mental stop. Personally, I always stick to hard stop. That means that the moment I enter the trade, I have an order automatically placed in the market that if the price don't go in my direction, I'm going to get stopped out automatically. So that's for me the best way to manage your risk, and it's a lot safer. But if you're comfortable and you prefer trading that way, you can use mental stop as well. The important thing is to always respect it and to know where your stop loss will be before entering the trade. So place stop just over and under the candle pivot point level, or over or under a big order. Let's see this example here on Tesla. So we saw the price going up right here, and we saw the price forming a fair value gap with those three candlesticks right here. So we see with those three candlesticks here from the high of the first candle and the low of the third candle that there's a gap in the middle. So here it's our gap right at R3. Then we see the price pushing a little bit higher, all close, pretty much close to R4. And then going up to R4, we have this beautiful candle right here. So a candle with a small price movement with a rejection from the top here with higher than average volume. This is our VPA sign, close to R4 in a selling range. Now we are patient, we're waiting for the price to reverse back down and fill that gap. So the moment it filled the gap here, that's where I will have entered the trade to the short side. Where I will have placed my stop loss would have been right here. So either at high of the day, if you want to give it a little bit more room, you can place it just a little bit over R4. We can see that our R4 here, we have the level which is 381. So you could have placed your stop at like 381.05, something like that. So entry would have been here, stop loss would have been here, and we would have been able to catch a pretty nice 2-hour move, partial here, and wait for more downside here. So like I said, in terms of profit targets, what I usually like to do is start partialing at 3R and go with a 50%. So if you take 50% at 3R, that's locking in a 1.5R already, which is pretty good. Then the moment you partial, you want to place your stop at break even and wait to see if, for example, in that case, if there is more downside, and then keep scaling out using support and resistance level. So same trade here, that's the risk. Here it's about, well, I roughly calculated, not quite 3R, but pretty close. Let's call it 2.5R. You take a partial here, and then you wait if there's more downside. And the next place I would have been interested in partialing will have been at S4 right here. So that 267.58, I would have probably take more off the table. So that's the way I take my profit off the table. Pretty straightforward. Wait for 3R. You can start partialing at 2R as well. It's really up to you, but don't start partialing before 2R. Wait at least that 2R target. And I think if you go to 2R, I will recommend go with 25%, and then you can keep with, let's say, a 25% at 3R, maybe 50% at 4R, and go like that at some specific levels. Also, rounded numbers is a good way to partial. You could have taken some at 370, more at 368, then maybe wait for 365, and you can go like that. But the most important thing in terms of scaling out of a position is be patient. Wait at least for twice your risk. That's really important if you want the strategy to be profitable in the long run. Now I wanted to share with you and talk about some common mistakes that I've seen a lot with this strategy and that I've experienced myself a lot of times. So I've been to all of those, and I think it's worth it to talk about it so you can be aware and maybe learn from those mistakes before they happen. The first one is not waiting for VPA confirmation. So like I talked in the beginning of this video, it's tempting sometimes when you see the price going to your level to enter right away expecting a rejection, but super important, you need to wait to see a volume and price anomaly. Really important. Then not waiting for the price to reach overextended territory in between S3 and R3. It could be really tempting sometimes that, let's say the price is in between S3 and R3. You see a beautiful VPA like really jumping into your eyes. Then you see a fair value gap. You see the fair value gap getting filled. And it could be tempting as well to jump into the trade. But if you're in the middle of value area, you should avoid, because usually when the price is in between S3 and R3, it's just going to be choppy and move around. So really important to wait for extended territory. The next mistake I see often and experience myself is not waiting to see an inverse fair value gap. So if I go back to the Tesla example, could have been tempting for me seeing the price reaching a selling range here, seeing a VPA, and then I could have been really tempted in jumping right here, or maybe jumping right here when I see the price trying to move higher, make a lower high, and then a 1 minute low. Could have been tempting to jump. In that case, would have worked anyway, would have even given me a better entry. But I realized with a lot of backtesting and playing this strategy for a long time that waiting for that fair value gap is going to increase your profitability. Another mistake I see often is over trading choppy price action. So like I said, if you trade in between S3 and R3, you're in choppy price action, you should stay away from entering a trade. The great thing about the criteria of this strategy is that if you're taking a trade in between R4 and R3 in a selling range, or in a buying range between S3 and S4, well, you're not into choppy price action, because for the price to go up there, it needed some kind of moves. So that's a good thing about the Carmela pivot point. Then placing your stop loss too tight from the entry point, that can cost you a lot of trades. Don't be shy to give it a lot of room with this strategy, because with this strategy, we're trying to catch the inflection point. It's a reversal. So often with reversals, you can catch massive moves. So even if you give a lot of room to your stop loss, you are able with the strategy to catch a big move in your direction. So that's the thing I actually like about this strategy. It makes it slower. You can stay in the trade for an hour, for 2 hours. So it helps you be patient. It's slower. There's less emotion with it. And yeah, the moral of that common mistakes is don't be shy to give a lot of room to your stop loss. Another one, and the last one, is scaling out too quickly of the trade. That happened really often to me. I get excited to see some profits, or I get scared that after seeing myself with a green P&L, seeing the price reverse on me and stop me out. So I don't wait for at least 2R or 3R and start getting out of the position too quick, or taking too big partials. That happens often. And it's really important, if you want to have this strategy to be profitable in the long run, wait for at least twice your risk. This rule is extremely important with this strategy. Hopefully by now you're starting to have a good understanding of how I play the reversal, how this strategy works, what we're looking for, how to manage the trade. If you're still a little bit confused, I want to finish up this strategy video with a live trade breakdown that I take, and let's dive into that trade and explain everything I saw go back to all the criteria, and hopefully by then we'll be more clear. So let's see this trade together, which is on PLTR. The first thing we want to pay attention to is where is the price standing in relation with the Camilla pivot point indicator. So we can see on my chart I have R4 here and R3 here. So the price is in a selling range. So in a selling range, we know we want to look for a potential short. Then when the price reach R4, it happens some really interesting thing. The first interesting thing that I see is this candle right here. So we saw a candle with super high volume. So this is a big anomaly because this candle here don't have too much movement. If we compare it to the previous candle, this one have a bigger price movement from here to here compared to this one from here to here. It's almost twice the move of this one. But the volume of this candle here is only here. So this volume bar is 3 times higher than this one here and is twice less movement. So this is a clear VPA for me that the buyers going close to R4 are getting exhausted. But we need to be patient here because the price is still not done moving higher, and we can see it here. Then next candle after that, price move up, and then we have a rejection right here with decent volume, price above average. So this is a good sign that, okay, some sellers are stepping in here. Here it could be really tempting to jump to the short side because we see VPA, we know we're right at R4. We could jump short right here. Where we would have placed our stop loss at that point, maybe right here to give it a little bit of room, we would have taken a loss on that trade. So that's the power of waiting for your fair value gap. So the fair value gap didn't happen yet. We could have argued that, okay, we were having a fair value gap in between this candle and this candle here, but the price never came back and filled that gap. So there's still no entry for us. If it would have happened right here, I could have entered short right here, then place my stop loss here and target a move lower, but the pullback didn't happen yet. So we're patient, we're letting the price do his things and see what's gonna happen next with reading candlestick by candlestick. Then happened another really interesting thing here. We kept pushing higher with this candle here, pushing through R4. And this candlestick here is a doji candle. So we see big wicks and a small body. So small price movement. And again, pretty high volume here above average, almost twice the average right here. So that's our second VPA, that the buyers are getting exhausted. So they're getting exhausted here. Then we have some decent sellers coming in. Then we're pushing up again and still the buyers showing us sign of exhaustion. Then if we look here, with those 3 candlesticks here, still no fair value gap. So we need to be patient here. Then after that, we have rejection right here. So a pullback with normal volume. I will say maybe a little bit higher than the previous selling volume we had in the past couple minutes. So that's a good sign. Still not enough for us to enter the trade. Then we have another push higher here with lower than average volume, which is good. We're seeing the buyers still pushing the price, but this time with really low volume. What is interesting, sorry, I was receiving a call here. So what is interesting here is that we finally formed a fair value gap. So if we analyze those 3 candlesticks right here, so we can see that from the high of this candle compared to the low of this candle here, we have our fair value gap. This is a great sign. Fair value gap, lot of VPA anomalies right at R4. So now we're really looking forward to take the trade to the short side. All we need to do is the price getting down and fill that fair value gap, and we're gonna enter right here. In that specific trade on PLTR, my entry price was not so good, probably because of the spread. The better entry would have been right here, but nonetheless, all the criteria were respected here. So that's where I entered to the short side with all the criteria respected. My stop loss just at high of the day, which is above R4. So here is my risk. Then I target little bit over a 2-hour move, close to 3-hour move. I partial right here. And then the next partial I took was right here, exactly at R3, which is a zone where I know there's some interest. Like we can see the price bounced pretty perfectly to the penny here. At that point, the moment I partial, my stop loss was placed at break even to protect myself, and I waited to see if there were more downside on that trade. Another area I would have been interested in taking partial, I have no idea what happened after that, would have been 157.5, and then maybe more at 155, and then maybe target S3 and go like that. So that's pretty much the way you want to play the reversal strategy. I hope it was a lot clearer with that chart example. So that was a reversal strategy. Hope you enjoyed it.